Thank you for watching the Finance and Affirmations podcast. I appreciate you being here. Make sure you click the subscribe button so you'll be alerted when I post new content. Enjoy the episode. Hello, Finance and Affirmations family. We have a special guest today. I'm going to tell you a little bit about him, and then we're going to get into a great conversation that I'm really looking forward to having. His name is Mick Heyman, and he's the CFA and founder of Heyman Investment Counseling. He has 40 years of wealth management experience helping individuals and institutions of all sizes build and preserve their wealth with a stress-free method for mellowing your money. And I love that emphasis on stress-free, because we know just dealing with finances, it's emotional, right? Even though the money itself may not be emotional, our attachments to the money and how it's used and the decisions that we make can be very emotional. And so Mick likes psychology, even though he received a Bachelor of Economics in Northwestern, and he had a formal education in economics. He really loves the psychological aspect and the philosophy of people and their money and the decisions that they make. And so, Mick, I just want to welcome you today. Thank you so much for being here.
Thank you, Katherine. I'm excited to be on the show, and I think you're approaching money the way you do is exactly the way people need to hear about it. So I'm excited to be here.
Well, good, because for me, when we think about, financial wholeness or even building wealth, for me, it's important to help the clients that I deal with to get to the bottom of why they're making the financial decisions that they're making. Because many times we do that subconsciously and we don't understand, where that's coming from and what's going on. So what has been your experience working with your clients, and what have you learned about the psychology of how people deal with their money?
So one thing that I've, at least my theory over years and years of working with people and also learning about myself, is that most of us don't escape childhood or young adult without some wounds that we need to deal with. And what money tends to do is expose those wounds, and each of us has the different paths that we took. And so my goal over time has been to make sure that we look at those emotions, because if you Google how to make money or how to invest in the internet, you get all the rules are there. It's not that complicated. You don't need a degree in economics to kind of follow make your savings, be the long-term investor, all those different things. But if you don't deal with your own emotions, the moment you come against some surprise, something that you didn't anticipate, you throw those rules out the window and you do something wrong, And we all have done them, by the way. And that's, I was listening to one of your guests, Haley Castillo, and we all make these mistakes. And if we look at them as our tuition, as our way to grow through them, then we grow as a person, and we can help manage our money in the future. And so that's my other message that I try to get across to my clients is, we don't escape this life without making errors in our life and grow from them. But one of the great traders back in the early 1900s said, just treat it as your tuition payment and move along. So anyway.
I love that. Treat it as your tuition and grow through that. That's a wonderful way of looking at it. And so you have done, been in the wealth industry for over 40 years. What drew you to that as a career? And then when did you begin to make the correlation between the decisions that we make and the psychology as it relates to money?
Sure. There were a couple of things that happened early on. First of all, I got into this career accidentally. And most people, they graduate with economics, say, I want to be an investor. I didn't know what I wanted to be. I happened to get an internship, and in my case, it was a lucky one. I joined a small firm in Cincinnati, Ohio, and we were helping, manage money for some wealthy individuals. I thought it was the key to making money. I mean, you're really, being a star. I wanted to be one of those, TV personalities and be a great trader. And that was my dream. And yet one of the biggest influences I had was my first client was a woman named Eloise, one of the most eccentric older ladies that I've ever met, full of fun and life and joyful. And all she wanted, she had a lot of money, but what did she want to do with it was give it away. So I met her the first day I was helping her buy a car. And I was an idiot negotiating. She was much better than me. But in the end, she invited me over for dinner. And she said, every Monday you're coming over for dinner and we're going to write checks and we're going to give it away. And so eventually that check writing led to book reading. And all of a sudden I realized, this investment management thing is not just about managing money, it's about helping people. And so that led to, of course, many different clients that I've enjoyed through the year. But I started realizing this business is getting to know people and what they were about. And one thing about working with her was she had all these stocks that she had owned that her parents had bought many years ago. And I realized that we couldn't sell those stocks because they had huge capital gains, would have required taxes to be paid. And so we didn't do much for her management wise. But guess what? At the end of the year, all these other, client accounts that we were trading in and out and trying to do all these things for, guess who outperformed? It was Eloise, who we were doing nothing for. And that was one of my first lessons, was sometimes doing nothing, just putting your money away in good companies and letting it grow is the best thing. But that's the hardest thing for any of us to do because we want to do things. We want to act. We want to be aggressive. And so that was one of the great lessons early on. And the second one was one of my first assignments was going to the library and getting data out of the newspapers from like the 1920s to try to put into this new computer that we had. And so that also meant I was reading headlines every week from the 1920s going forward. And guess what? Like today, about every week or two, the world looked like it was coming to an end, whether it was politics or economics or war or any of these different things. It always looked like, oh my gosh, we can't survive this. And guess what? Next week, there was another newspaper printed. And that also taught me that all these things that we get confused by, I mean, the amount of noise that we're facing today with social media and people on 24-hour news cycles, and I'm not saying they're intentionally scaring us, but that's the result. And yet next week, the things that might have scared us, we're not even remembering what they were because there's another host of things to scare us. And so that's what I've tried to do with this kind of mellow outlook, stress-free outlook on investments is try to let it go. Deal with your own emotions and then let it go and don't try to do too much.
So let's get into that a little bit because I know that you have a book that's out that came out middle of 2023 called Mellow Your Money. And so I listened to it on Audible, and in listening to it, I enjoyed the stories that you were telling about Eloise and some of your other clients. And so you talk about mellowing your money. What does that mean?
What it means is in a certain way, it means drowning out that noise. But in order to do that, we need to deal with our own emotions. One of those stories in that book was and the other thing was that there's so many textbooks on investing. What I wanted to do is have a book that, dealt with stories because that's how I learned my lessons. And so it's not just these happen to be my stories, but I wanted people to realize that each of us have our own stories to learn these lessons from. But one in particular with me was the relationship I had with my dad. And growing up, it was a tough one. And of course, there's millions, hundreds of millions of people that could tell stories about their relationship with their dad. But with me, it was all about competition. And when I had my first problem with my first marriage, I remember going to the therapist and wanting to deal with the marriage, wanting to deal with that relationship. And he kept saying, it's about your dad. I didn't want to talk about my dad. I wanted to talk about the marriage. But I realized finally that all these mistakes that I had been making was about trying to compete with different things in my life and trying to compete with the market. And guess what? If you're trying to compete with the market, I know who's going to win. It's like competing with the house in Las Vegas. You aren't going to beat it. And when I finally dealt with that relationship with my dad and talked to him and found a loving relationship that we could move through and get through some of the issues that we've been fighting about for years, it opened up so many things and opened up myself. And I realized that each of us, some people have no issues like that with their parents, but everyone has something. And when you finally opened up, then you can, when you can meet your objectives and not get so excited by all the noise that's trying to distract us.
And so it sounds like with all of your clients, especially after listening to your book, you have a unique story that each of them helped you with in some way. And so because I believe you still have clients today, right, that you still work
Correct.
with.
Yes.
And so what have you found has been the way that if it's financial trauma or their emotions, how does that show up when you are helping them with their portfolio?
Sure. I have one client in particular who had worked with different advisors, and every mistake you could make, he found. In the late 1990s, guess what he owned? A lot of technology stocks.
Mm.
And he was making a lot of money, but all of a sudden he had no money because it went down the drain with technology. Well, he finally recovered from that and found a different advisor that bought him a bunch of bank stocks before 2008. And of course, you know what happened with those.
Right.
And so he was introduced to me and very skeptical, not believing in anything. But one thing I stressed to him was if we stick to his objective, no matter what happens, he's going to be okay. He may not be the richest doctor in the world, but he's going to be okay relative to what he needs to retire on. And so we set these objectives. And believe me, about every 6 months, something would happen politically or economically. And he'd call, Mick, what do we do? And I'd say, well, let's look at your objectives. What would happen if this happens? And what's the worst case? And he'd say, okay, I think I'll be okay. And finally, and we even made it through the pandemic with, of course, there was a period of time in March right after the shutdown where the market dropped 35% in 3 weeks.
Yeah.
Well, believe me, that was scaring all of us. I was in the grocery store buying toilet paper with everyone else. But if you know what your objective is, you can say, hang in there. This is another point where it looks like the world is coming to an end, like it felt like after 9/11, like it felt so many different times. If you hang in there and you set your objectives right the first time, you're not going to panic out when everyone else is. He was calling me up saying the same thing. Oh no, here I go again. It's like, no, this time you're diversified, you have the right objectives, and of course we come through it. Well, since the pandemic, there have been numerous things to cause us to be afraid, whether it's politically, economically, or whatever. And now he's writing me emails like, Mick, I know what you're going to say. I just want to hear it again, you know? And so, if you stick to your objectives over a long period of time, eventually you can face these surprises which come out of the blue with more calmness. And I guess that's my goal. And it's my goal in my own life too, because believe me, I may talk a good story, but things happen in my life that shake me. And you have to go back to your long-term objectives. And also the other thing is people are making money all around us on different things, right? There was Bitcoin and there was these meme stocks and there's these, believe me, Beanie Babies back in the 90s. And there's always something to scare us away from our long-term objectives. And so that's the other thing that I try to tell people is it's okay that someone makes a lot of money on something that we don't understand. Let that happen. It doesn't have to be part of our long-term plan. And so
I love that so much because yes, I am an investor. Of course, everything was Bitcoin, 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 the last few years, and then that has had a drastic change. But you talk a lot about staying with your long-term plans. And so in listening to your book, there was one rule, and we're going to get into just some of the investing tips that people want. I think you talked about a 60% rule. So what is that and how does that apply to us if we're looking to be investors?
sure. And just to qualify that, some people fit exactly into that 60% category. They want to balance, they want, over time stocks have done well, so they want to kind of tilt things towards stocks. For some people, whether they're older or younger, 60% might seem too high. It might seem too low. So that's the other thing, is to get in touch with how much risk can each of us take. And so we have to actually put in our mind if it's our first $1,000 or if it's our first 25,000 or $50,000, whether it's 60% or 40% or 80%, if there's some surprise out there, can you take it? Not just financially, but emotionally. They say put a kid in, 100% in stocks. Well, if that 100% goes down, if it's his first $1,000 and then he sees it at 700 and he quits investing, then that was the wrong pit. That was the wrong objective, and so, but in this case, let's go back to that 60% example. Let's say that long term, that is your objective. And let's say that over 2 or 3 years, which we saw a few years ago, we saw 3 years where the market was averaging 20% a year. If that happens, guess what? Your 60% isn't going to have 60% in stocks anymore. It's going to have 65 or 70% because stocks are going to take over your portfolio. They will go up more than the safe money will. Well, that's the time to cut back. And believe me, when the market's up, everyone's excited. And so when you cut back from, say, 65 or 70% exposure back to 60, you're selling when times are good. And everybody out there that, these great economists are saying, things are good. Well, why? That's why the market's up. That's the time to cut back. And you're cutting back, you're not rooting against the market. You still have 60% in stocks. So you're still hoping it goes up, and you're hoping you look back and say, well, too bad I sold at a lower level than stocks went up. But the discipline means you're selling when stocks are high. That also means that when that accident happens and you're at 60% and stocks go down to 50 or 55% because the market's gone down, that's the time to add back in and get back to 60%. Well, what that forces you to do is sell high and buy low. Well, we always hear that, buy low and sell high. But if we listen to our emotions, we're going to feel bad when stocks are down and sell when things are low, and feel good when things are high and buy more and sell high. So if we listen to our emotions, we're doing the opposite. If we become more like a mechanic, we're selling at higher levels and buying at lower levels. And I would say every once in a while, I may have gotten it right, but most of the time, my best buys were mechanical. They were when stocks were at a lower level in someone's portfolio, and I thought, we ought to get back to the objective. Or if stocks were too high, and I thought, we ought to get back down and we ought to sell some. And so being more of a mechanic means minimizing those emotions.
That's a great point. I teach an investment club class to sixth grade through 12th graders. And one of the things that I tell them is, we say we don't panic when the market goes down. What do? And we say cha-ching because we know that stocks are on sale. And so that's in line with kind of what you're saying, and making sure that you always stay balanced based on what's going on in the market. And one of the other points that I really appreciated in your book, because I know I have suffered with this myself, being okay with incremental gains. Can you talk a little bit about that?
Sure. And that too is and every once in a while, some of us might get lucky and buy a little Bitcoin and see it soar like that. And when we do, we feel really smart, and maybe we are. I'm not saying that everyone is just dumb luck, but when that happens, be willing to take profits along the way. Backing up a little bit, every once in a while, when we get these big gains, and whether it was dumb luck or whether we were made a smart move, we have to realize that these gains can go away. And so when I say be happy with incremental gains, is when something works out for us, be willing to take some off the table. And so imagine, and here's an example, whether it be Bitcoin or Apple Computer back in the early 2000s. Say we got on top of that and Apple goes from 2 to 6 and we feel really smart. We just bought something that tripled and we feel really good about that. Now there's two mistakes we could make. One is feel so good that we sell the whole thing. And so you do that. Well, guess what? You missed out on all the gains that Apple may have made for the next 20 years. And so don't feel like we have to sell a whole position just because we got lucky with it. Same thing with whether it's something speculative with Bitcoin. But on the other hand, be willing to sell Apple along the way. Now, maybe you sold a little bit at 6, and if it was, 3 or 4% of your portfolio, you took it back to 3 or 4%. It doesn't mean we're rooting against Apple. We want that to be a long-term gain, but it's not bad to spread that around. And who knows, maybe you took some of that Apple and you bought some NVIDIA with it. And that went off and goes crazy. So it doesn't mean that when you sell something that you're just cashing in, you're going to do nothing. But it does mean that you're protecting yourself, because that same person might have bought some BlackBerry too along the way. And we all used to have BlackBerries, I think.
That's right.
And now it's all sitting in our closets or somewhere in a dump. And so is the stock, by the way. And so, somewhere along the line, BlackBerry was a great stock.
Right.
But if you never took any profits along the way, and who would have predicted? I didn't. I didn't predict that BlackBerry was going to either soar like it did or collapse. But when you have a little bit of that stock and you sell it along the way on the way up, it means you don't have to worry about the disaster when occasionally these things do take a dive.
For sure. And so you talk about 3 pillars, I believe it is, as it relates to investing. Can you talk to us a little bit about that?
Sure. And of course, I learned about these pillars back early in my career when I ignored 2 out of 3 and bought some. I think I bought a steel company that turned out to be the biggest bankruptcy in American history. I'm not selling you on my brilliance right now, but it was such an embarrassment and could have ended my career. But
join me on a future episode as Mick and I continue our conversation about the 3 investing pillars he follows and the importance of affirmations. I hope you enjoyed watching the Finance and Affirmations podcast. If you haven't already done so, click the subscribe button. Until next time, blessings.